All right, good afternoon, everybody. Welcome. Thank you for attending. My name is Andrew Schaefer. I'm the Managing Director of Trafalgar. I'd like to welcome you to our third client webinar, and I'd like to introduce the panelists for today. We have Karine Coetzee, who is a property management consultant with Trafalgar, more than 20 years of experience with managing community schemes, both sectional title and homeowners. We have Shahim Kar, who's a director of Trafalgar, also more than 20 years experience with managing sectional title and homeowner schemes. Shahim also has a special interest in the financial management topic that we're going to be addressing today. And we have Dave Hershowitz, our final panelist. Dave is a CA, and Dave is the National Accounting Manager for Trafalgar, managing all of the 30 plus accountants working across Trafalgar's branches involved with budgeting and financial management. So welcome and thanks once again for attending. This is our third webinar series. The first was enforcing the conduct rules. Second was the effective collection of arrear levies. And today we have budgeting and financial management. We do post recordings of all of our webinars onto the Trafalgar website, specifically on the page trafalgar.co.za/webinars, but anyone is welcome to email me afterwards. We can send the copy of the slides as well as a YouTube link for this particular webinar. So that is available on request. Please do email me. It's awkward to pick up emails from the Q&A and extract them from there, so an email would be easier to reply to. Please feel free to ask questions at any stage. Please use the Q&A button below. I will do my best to moderate questions, to group them, to refer them to one of my colleagues, and to make sure that we try and answer all of the questions. If we do run out of time, please do email us or call us, and we'll certainly respond as best we can afterwards, or even going forward. That would be absolutely fine. All right, moving into the topic of today, budgeting and financial management are absolutely crucial for the effective property management of a community scheme. The finances and cash flow lie at the heart of a well-run and efficiently operated scheme, and therefore it's an absolutely top priority both for us as Trafalgar as well as for all trustees and directors that are involved. It is not necessary to be a qualified accountant to play an active role in the financial management, and hopefully today's presentation will demystify a lot of the uncertainties which do arise, and hopefully it gives a fairly practical and a fairly clear guideline of how to go about the process of effective financial management in community schemes, which covers share blocks as well as sectional title schemes and homeowners associations. I'm going to hand over to Karine, who's going to start us off today just reviewing the legal provisions and parameters which refer to the topic of today. So Karine, over to you. Thank you.
Thanks, Andrew. So here on our first slide, we just have an overview of all the different acts that is pertinent for complexes, be it body corporate or homeowners association. So if you just go to the next slide, please. Okay, so in terms of both sectional title schemes and homeowners associations, they all fall under the definition of a community scheme as per the Community Schemes Ombudsman Service Act. And this act then says that all community schemes have certain duties in terms of financial management. One being to raise monthly CSOS levies on all units, and then to pay over these CSOS levies quarterly to CSOS. There's also a stipulation that all community schemes must submit annual returns to CSOS. This includes the annual financial statements, and this must be done within 4 months after the financial year end of the complex. So this is for both sectional title schemes and homeowners associations. A third requirement by the CSOS Act is that the complexes, all community schemes, must have adequate fidelity cover on the scheme's funds, so that if somebody runs away with your money, that you have cover, insurance cover for that. So that is, all of these are requirements of the Community Schemes Ombudsman Service Act. Then if we go to the next slide and we just look at sectional title schemes, there's certain things that are provided for in the Sectional Title Schemes Management Act, and this only applies to sectional title schemes. This does not apply to homeowners associations. And the first being that the Act stipulates that a complex must operate two funds, the administrative fund and the reserve fund. Both these funds must have their own budget, their own bank account, and their own books of account. So the administrative fund basically covers the operating expenses of the complex, the day-to-day expenses, and the reserve fund covers the planned maintenance that is set up in terms of a 10-year maintenance plan, which is also a legislative requirement for sectional title schemes. These budgets then need to be approved at the general meeting by the majority of the owners before they can be implemented. And it is important to note that expenses differ from complex to complex. So it's very difficult to compare two complexes with each other to say, but my levy is higher than your levy, and why is that, and all of that. Expenses differ, and the levies are a function of the expenses. And the income is mainly derived to cover these expenses, and income will be by raising levies, admin fund levies, reserve fund levies, special levies, exclusive use levies if there are exclusive use areas. Okay, then the Act also makes provision for the recoveries of expenses. So it is suggested that you have installed separate water or electricity meters. This can be done by ordinary resolution, and this will make sure that people pay only for their own consumption and not just pay as part of the levy. It is also possible to install separate prepaid meters. For this, you will need a special resolution, and you must give 60 days notice. Another form of income for a sectional title body corporate is rental income for the common property. So it is possible, for instance, like parking bays or storerooms, to rent this out to owners or occupiers. And basically, to determine what resolution is needed for this, you will have to ask a couple of questions. The first question will be, who is the person that is renting the common property? If it's an owner or an occupier, then we go to the next question, and that is for what period they are renting. If it's an owner or an occupier and they're renting for less than 10 years, you would need a special resolution to be passed for this. And if it's an owner or occupier and they're renting for 10 years or more, you would need a unanimous resolution to be passed for this. So that's normally parking bay, storerooms, as I said. Then for a third party to rent common property, this is normally an example would be for like a cell phone company to rent roof space to put up a cell phone tower. That is a third party, and for that you will always need a unanimous resolution. Doesn't matter what the period of the rental is. The body corporate can also give a loan to someone. For this, they would need to pass a unanimous resolution, and the body corporate can borrow money for certain projects or things that they would like to take part in, and for that you would need a special resolution. The Act also says that financial records must be kept for at least 6 years. Okay, if we can go to the next slide. Okay, then basically there is an audit that needs to be done every year for a body corporate. The default financial year end since the new Sectional Title Schemes Management Act came into being is September. That doesn't mean that all complexes now have a September year end. It is just for all new complexes developed since 7 October 2016. Before that, the default year end was February, but it is possible for a complex to change the year end at any stage. You just need an ordinary resolution to be passed for that. And then the audited financial statements must be prepared every year and tabled at the annual general meeting. There used to be an option for smaller complexes of an accounting officer, but this has been removed since the new Act came into play. And that's basically that.
All right, many thanks, Corinne. Let's carry on, Shane. All right, I was going to talk about slide 10. So the new legislation for sectional title schemes was promulgated on the 7th of October 2016. The main changes really at that time were the CSOS Act, which Corinne went through in terms of the CSOS levies to fund the CSOS Ombud service, which plays an integral role in dispute resolution and community schemes. And the CSOS returns to the CSOS Ombud really give them an indication that the complexes are registered and that the CSOS levies are correctly quantified and paid across. The 10-year maintenance plan and reserve fund was also a new provision of the legislation, and that has been an implementation process since October 2016. Overall, I would say that approximately 80% of complexes which Trafalgar manages are compliant with all of the legal provisions, and the remainder we're doing our best to help get compliant on the basis of getting the 10-year maintenance plans arranged, and then making sure that the reserve fund levies match the 10-year maintenance plans. And with those particular buildings, there are constraints in terms of finances or cash flow or buy-in from the trustee and directors, trustee stakeholders, and that's a process that we are trying to follow. But it's obviously really important that the governance of these complexes is correct and up to date with the new legislation. There has been some time available now to get it done. So I think CSOS is now taking a dim view of outstanding budgets, outstanding items, outstanding buildings, given that it is nearly 2 years since the new legislation was implemented. And so I think it's, it's really an expectation of trustees and directors to make sure that they are advised of the compliance requirements, that they are in line with those compliance requirements. And as Trafalgar, we're obviously available and ready to assist to make sure that can happen as easy as possible. We will touch on some of these governance requirements in upcoming webinars, but there has been good progress, but there are some gaps which need to be closed. I'll now hand over to Shahim, who will take us into the budgeting and financial management topic. Thanks, Shahim.
Hi, good afternoon, everybody, and thanks for joining our webinar. I want to start off my presentation with just some sort of, and set the tone in the way that when people actually buy into complexes, they either buy for security reasons, they actually want to maybe form part of a community, and in some instances it's first-time home buyers, it's their piece of Africa. And what all these people actually have in common is that they would like to know that, firstly, that there's a good managing agent looking after the complex, secondly, that there's money in the bank accounts, thirdly, that there are compliance, and obviously, that there are adequate reserves and anything else that would actually make a difference in sort of the management of the complex. For us as a company, I think we've just highlighted a few key pillars of financial management on this slide. And I think the first thing that is very important to everyone is really the cash control and management. I think without cash, certainly, a lot of what we can't achieve is constrained with cash. The other thing that is also very important is compliance. But I'm not going to touch on all of these. I'm going to just touch on the important questions to consider. So a lot of the time when we ask the question, is the levy base correct, is that when people have for many years done only 4 or 5% levy increases, they're expecting at some point to paint the building. But, then to deter that is obviously the fact that when the building has to be painted, I need to raise a special levy. So what I think the Act is allowing us to do right now between the two funds is to really somewhat demonstrate the fact that your day-to-day expenses can be easily covered by adequate increases. And then your reserve fund is really a long-term plan where your future savings, no different to your own budget, And so for us as a company, we would like to ensure that those are always aligned. The important thing is also about the cash provision of the body corporate. You'll notice that when you go to body corporate meetings, a lot of the time people spend a 5-minute discussion on finances and the other 4 hours is really operational. I think now with COVID-19, I think we must all press the reset button and really sit down and have a look at our cash. Trafalgar can offer cash flows and things like that, and really we can certainly look at a long-term objective for complexes that need assistance. And a lot of people don't actually look at their levy collection rate, because remembering when you do your first budget, the assumption is that you will collect 100% of your levies. But literally in every complex there are challenges, so we need to know what that is. And obviously the main thing is, can we actually pay off our immediate and long-term obligations? In some instances, when we're eroding our cash resources, when people are not paying, etc., the day-to-day expenses are important, and sometimes there are disconnection of electricity and water, and that is as a result of us not managing cash adequately. And then are the large outstanding creditor balances. I think a lot of people don't actually do accrual accounting. Trafalgar does offer that service, especially when we're compiling our year-end accounts. And so we do look at supplier statements. And then obviously do our normal income streams cover our day-to-day expenditure? And that's what we've touched on earlier. And then also in terms of the 10-year plan, what are our capital projections? Because I think what we all need to realize is at some point things are going to break. There needs to be a long-term objective to paint the building. There'll be waterproofing requirements and various other maintenance things that are actually part of the 10-year plan. So how compliant are we in terms of the following as a business or as a HOA or even a body corporate? Like, so the act has been promulgated now. You can see Andrews alluded to that 20%. So is your complex part of the compliant Sectional Title Schemes Management Act? And as a HOA, is your HOA or your company compliant in terms of the Companies Act? And then obviously there are other acts that you have to really be compliant with. So Trafalgar obviously can assist with all of those. So my next slide really is going to be a checklist. And it is really our belief as a company that 80% of property management is really financial. I'm not going to touch on all of these, but we really wanted to just show what are the checks and balances that should be in place for a body corporate or homeowner association to be adequately managed. But I want to touch on having the AGM in the prescribed period. The things that go into that meeting is really a set of financial statements that have to be signed off. And the main thing really is the approval of the budget. And that is the opportunity to make sure that we're actually reviewing all our income and expenditure and to set the basis and everything else correctly in line with where we're going. A lot of the non-compliant buildings, they normally don't get to actually have meetings in time. And then what that happens is the erosion of your cash. You don't have the increase actually when your expenses are increasing annually by 6% or 8%, you're still sitting with the same levy base and there's no increases. It's almost as if you have no salary increase but your expenses are increasing. What is going to start happening? You're going to erode your reserves and your savings. And so what we think is if you just want to be compliant as a silent partner, we can give the best advice, but it is really ultimately the boards and the trustees' decision. So as we know, as our industry is expecting trustees to actually, like in their spare time, manage complexes. Firstly, we know it's a thankless job. You don't get paid. But I do think that there is a major duty of care when it comes to financial management. There's millions and billions of rands running through hundreds and thousands of complexes across the country. And sometimes with respect, we don't have a financial trustee or accountant on the actual board, but we are actually expected to be able to actually make these financial decisions. So hopefully this best practice guidelines can assist with sort of getting you on track. I'm now going to move over to Trafalgar's best practice guidelines. So with automation and let's call it a real-time system, we are able to produce what we call a chairman's pack within the first 10 to 15 working days of the following month. And as a trustee, I think, again, I'm going to just allude to the fact that I don't think people are spending enough time analyzing information. So what we do provide is a whole pack. And I'm not going to cover all of it because Dave will show you later on where we're heading in terms of dashboard reporting. But it is important for you guys to actually focus on the balance sheet. I mean, that is really the net worth of the actual estate. So hopefully, if it's not a Trafalgar, Trafalgar's not your managing agent, whoever is managing you does provide these kind of reports. The other thing which is very important to look at is really your income statement. And this is where you'll be able to pick up the erosion, where the expenses are in line with budget, etc., etc. And also your arrears reports and actually where the money is going and who we owe money. What we have found in the last couple of years, especially with our municipalities, unfortunately, based on estimations, a lot of leakage happens with municipal accounts, and unfortunately, with council, they just disconnect. So you're almost forced to pay. So I think it's very important to have a look at what the recovery ratios are. And I think a best practice is between 90% of actually what we recover, and the 10% should be the actual common area. But there is no real plan with COJ currently, as we know that they're still having issues, and we need to take ownership of those kind of things. And I think it's important that trustees manage that adequately. The next slide is really just going to show you in terms of the budgets. So I think from a budget perspective, from our side, we believe that a 9-3 budget is actually a best practice. The reason for that is that in the 10th month of the financial year, we can already actually send you the budget because we can forecast the next 3 months. And because trustees are now allowed to actually have, the Act allows a 10% automatic increase, you can actually increase your admin fund, which is your day-to-day expenditure already. So a lot of trustees don't prefer this method because they would like to go to the AGM. What then happens is a lot of the time the increase only happens in the following year, in the middle of the year, because bearing in mind you still have to give notice, and then obviously your AGM can be held after the financial year. But maybe a best practice and a consideration for trustees should be that you can actually increase the admin fund already, and then deal with the 10-year plan and the bigger increase at the meeting if one is required. So from our side, what we're suggesting is that all our clients that they should consider looking at a 9-3. The not recommended one is the 12-month, but again, we can compile a budget like that, but then you don't actually really recover the full amount, because let's say your financial year is the 1st of March, you're actually doing the budget in March, so you can't actually backdate the increase itself. And then obviously for distress complexes, I mean, there is really a turnaround strategy, but in complexes like these, you really have to do a forecast. And I think you can do a multi-year one, 2 to 3 years, because like you can't expect a distress complex to actually just turn around within 12 months, because you're looking at huge increases. So obviously we can have a nice financial model, look at it, and we can certainly assist with those buildings. And then in most instances, complexes that have late AGMs, it really is a good practice to prepare the following year's budget so that we know where we're going, and that obviously, you know, you can get a good picture of what the 2-year increases should be for you to be able to catch up with your expenditure. Obviously with auditors as well, I think a best practice now, especially with the audit provision, the audit profession taking a lot of strain, I think for a body corporate or company, it's good practice to actually get different auditor quotes. This can be done annually through our offices. We prepare an electronic audit file that is actually sent off immediately after year end. And obviously, there are lots of auditors based on sort of our relationships that can actually audit within a time period of 2 months after the year end. So it's important to actually have these guidelines and audit timetables for you to have your meeting within your 4 months. And then from now on, I think what auditors can do, and this is what trustees have to be aware of, is that they're starting to qualify financial statements that are not compliant in terms of the 10-year plan. And previously they couldn't make that assumption as to how much, if there was adequate reserves. They can actually do that now. Why? Because there's a formula, there's a minimum amount, and there's also the 10-year plan. The banks are obviously also looking at it and saying, hold on, if a company or even a body corporate is insolvent, I don't think they're going to be granting bonds anymore. So I think also when we're protecting someone's investment, which is property, I think people that are looking after the financials do have a duty of care, because property appreciates annually at quite a high rate, but it can also depreciate if you're not looking after it. Okay. And then obviously in terms of the income tax, what we are finding unfortunately right now is that because the Act requires us to save money, a lot of our complexes are starting to pay tax even after the exemption is allowed. There hasn't been anyone that has gone too far to actually, you know, decide whether we can actually challenge the 50,000 and maybe increase it. But what we do find is that now that we are paying, even if bodies corporates, obviously, I mean, all bodies corporates have to register. And then obviously what we would like to achieve with our complexes is to get a tax-free certificate for all our complexes after 1 month after income tax is submitted. And we do offer a public officer services for all our clients. So that is pretty much my slot, Andrew. We can continue with the budgeting process.
All right, could I just make a few comments based on questions that are coming through? So from a Trafalgar perspective, we see the start of the budgeting process as the critical point in starting the annual financial cycle. as Shahi mentioned, it's crucial to start the budgeting before the financial year end and to make sure that the forecast is defined. Typically, we would like the trustees or the directors to approve the budget before the end of the financial year. And as you heard, sectional title buildings are authorized to increase levies by up to 10% at the beginning of the new financial year, meaning that the levy income can be matched to the forecast expenses right from the outset of the beginning of the financial year. And this would then prevent a much higher increase if the levy increase was delayed till the AGM, which is typically only 4 months after the financial year. So it's really, really important that we budget in advance. And practically how we suggest it works is the Trafalgar accountant concern would prepare a forecast budget based on the 9 completed months of the financial year. Ideally, the accountant should engage directly with a finance trustee or director and work through any potential changes until the point where the finance trustee or director is agreeable to that budget and really should take ownership of that budget to agree it with the trustees or directors at a formal budget meeting where the budget is approved by the collective of trustees or directors. At that point, the budget can then be the working budget for the new financial year. And to emphasize again, if levies need to be matched to forecast expenses, they can be implemented with the increase from the first of the new financial month for sectional title schemes. Remember, the budgeting is typically an expense-based budget, so the expenses are forecast and the levies are set to cover the forecast expenses. We often ask, what do the levies cover? And the budget, as approved at the AGM, really gives the breakdown of what levies pay for, what levies cover, and how the funds are actually applied. And we actually do a nice pie chart showing the breakdown of the expenses and the percentage contributions of that. So it can be quite a lot of backwards and forwards finalizing a budget. It doesn't need to be if the accountant and the finance trustee or director work together to get a final draft. And then in a budget meeting, which the accountant can attend with their laptop, any final changes can be made live in Excel on the budget to complete the meeting with a finalized budget, which can then be implemented from there. At the AGM, the budget can be updated with the few months of the financial year which have already arisen, and then at the AGM, the members present typically approve the budget based on an ordinary resolution, and the budget then becomes implemented at that point. So that budget is crucial because it then sets the income of the building to cover expenses. There should be allowance made for any debtors or arrear levies, which has been the experience of the building, because the cash flow does need to be considered, and there certainly is a cash flow worksheet which is part of the budget model, so the cash flow can be evaluated at the same time as the budget to make sure that there is positive cash flow forecast for the building. So Dave will now talk us through the next steps from the budgeting process, but really important to remember this is a critical activity, should be done in advance of the financial year end. So important to set the levy income correctly to cover the expenses. And one of our challenges is we often get pushback from trustees and directors who decide that the levy should not increase by more than 6% because 6% is inflation. Now that's all very well, and obviously we all need to share a cost-effective focus, trying to make sure that the increases are as low as possible, that the levies are spent as prudently and professionally as possible, but the building does need income to cover expenses. Otherwise there's a risk of creditors not being paid, of services discontinuing, or of maintenance not being done. So there's a tight balancing act to make sure that as much as levy increases need to be kept as low as possible, we do need to take cognizance of the income required to service the building's need and make sure that there is some reserve and tolerance in that. All right, thank you, Dave. I'm going to hand over to you for the next section.
Okay, thanks, everyone. Well, good afternoon, everyone. Thanks for making your time today. As per my introduction, my name is David. And I'm just going to talk a bit more about the budgeting process and just look at it from a different viewpoint. So the important thing, and we've emphasized already about best practice for budgeting and why it is so important to have a good budgeting process. And I'm pretty much going to recap a bit of what's been discussed and just allow you to take a step back in terms of the budgeting. Because what I've also found, it's so easy to get lost and involved when doing a budgeting process that a process that could take pretty much a month ends up being 3-4 months because everyone gets lost, it gets overcomplicated. So what I want to do is when we're actually involved in a budgeting process, I think the first thing to understand or to remember is when we're doing it, we just got to understand what are the different components of the budget. Because if we take it a simple approach, we can answer all of our questions when doing the budgeting. So there are for me 3 main areas and parts of a budget and of a budgeting process. And whether it's a body corporate or an HRA, they all cover the same. So the first thing is the admin funds. An admin fund and maintenance reserve fund, there are terms more related to sectional, title, and body corporates, but an HRA will also have to cover the costs that we associate with a reserve fund. So the first part is the admin fund. And really, what is the admin fund? When you're doing a budgeting, we're looking to see what are our day-to-day costs and expenditure. That's the whole idea of the admin fund, is we want to make sure that we're carrying on for the foreseeable future. The budgeting period normally is 1 year, but as mentioned earlier with best practice, if there are distressed buildings, it isn't a bad idea to almost do a 2-3 year plan in line with your budget, and also allows the homeowners a bit better idea of the expectation. So the first component is admin fund day-to-day. What are our day-to-day expenses and incomes that we're going to have? The next part is the term reserve fund. Now for a body corporate, there's specific rules about the reserve fund in terms of the Sectional Title Schemes Management Act. And the reserve fund, this doesn't cover your day-to-day. So it's not like your burst pipe that you need a plumber to come in to fix it. This is your long-term capital maintenance projects, which expand over a couple of years. So it's a plan. And then ultimately the last component, which is very, very important, once you've gone through all your budgeting and you've identified what is your day-to-day, what is your capital maintenance expenditure, is where we're going to be at financially, the financial position, solvency. And the term solvency is, can we cover, do we have more assets than liabilities? Can we cover all of our obligations? That's very important. And unfortunately, it can be lost in the budgeting process where we're so busy trying to do our day-to-day, our admin, our reserve fund, we don't actually see where we're going to be afterwards. Okay. You can go on to the next slide. So we understand the components, and I just want to make mention, although I said admin fund and reserve fund is 2 processes, in your HRAs, you're also going to work out what is your capital and project expenditure that's going to happen for the year. So once we know these different components, what is the actual purpose of a budget? Ultimately, when you're doing a budget, you're trying to work out what are your obligations for the year. In order to work out your obligations, the biggest question every homeowner wants to know is, how much levies am I going to pay? So we're trying to work out and calculate our levy amount based on identifying, using good judgments and estimates and practices, what our obligations are going to be. And this is going to be for our admin fund, our reserve fund, and then obviously there's obligations, legislative obligations for CSOS. Once we've done that for the current year, we must also be able to forecast where we're going to be at financially. So we're just bearing in mind, when we're doing the budgeting, we know the components, we know what the purpose is, we want to find out what our expenditure is going to be, and what do we need to cover our expenditure. So once we do that, you can go into the next slide, we need to put a methodology in place. So it all links up to the same thing. So once we identify, okay, we've got an admin fund. How are we going to finance our day-to-day expenditure? We're going to work out a levy. And the whole methodology that we use, the common practice, is that our levy is really there to match our expenditure. And as you can see from the slides that I've put up, we prepare a break-even budget, which means there's not going to be a profit at the end of the day. This is the normal general methodology we use for well-placed, good complexes that are financially doing well, but we want our levies really to match our expenditure. You can have those situations with an HRA where you don't necessarily just want to break even because you want to build a bit of a reserve. And in some cases, and that's why I'm going to get to solvency, if you're in an insolvent position, you won't do a break-even budget because you want to be raising funds. It's actually going to allow you to turn around from an insolvent to solvent position. That's in the admin fund. You're identifying your obligations day to day. The reserve fund, although the Act actually has legislative requirements for your minimum contribution that you need, as well as your 10-year plan, ultimately, what are we doing? I look at your 10-year plan, you're identifying your obligations for the next 10 years. And you are trying to raise levies in order to match those obligations. So that's really, I mean, in a nutshell, we're identifying our components of the budget. It can be quite a simple idea, but we want to work out what is our forecast and expenditure, cash flow requirements, where we're going to be, and how much levies do we need to cover our expenditure. Okay, you can go into the next slide. So with all this in mind, let's just look at the timelines for the budgeting process. So we've alluded to best practice, and I thought I'd just put in a slide here in a bit more of a timeline idea. So it's recommended a 9-3 budget. And the whole idea is you want to have your budget approved before the start of the new financial year. This then allows you to gauge where you're at, how much levies will you need, how much of an increase it will be. And so it is very important to actually start your discussions early. So a 9-3 budget means you're starting in the 10th month of the year, 2 months before year end. Your 9th month management results will be out. You can start looking at forecasting your assumptions for the upcoming year. And this is where the accountant starts getting together with the portfolio manager as well as yourselves, the trustees and directors, to start discussing the plans and requirements for the upcoming year and what the budget will be. What this then allows, by the time it comes to year end, your budget can already be approved. You can identify what your increase is. And if your increase is going to be a big increase, and unfortunately in today's society with the economy and how the rates and utilities and expenditures have actually, the inflation has increased so much, it allows you the opportunity that if you need more than a 10% increase, you can get that approved for the start of the new financial year. So from day one of the new financial year, you can get at least your 10% increase. From there, the rest of it, if you needed more than 10% increase, then that'll be budgeted at the AGM. It becomes challenging and tricky, and I've seen it in practice, where if it's not done early enough, the budgeting process, and if it's not approved before year end, financially, even if you get your 20% increase at the AGM 4 months later, it makes your financial situation a bit more difficult because your cash flow isn't coming in. You're not getting that 10% that you would have had if you approved it earlier. And then obviously my last timeline, it depends. If you're a body corporate, you've got a 4 months after year end to have your AGM. And that's ideally when you've had the rest of your budget approved. For an HOA and an MPC in terms of the Companies Act, you can have it 6 months after year end. And this just allows a more of a smooth process, and it gets the discussion and thoughts going. And also, if you're starting your budgeting early, then you can start communicating easier to the owners earlier and making them understand and realize there might be a big increase. I think it does just help the process a bit more that way. Cool. Okay, so the next area I want to talk about, and this is going to link to the monthly reports. Us at Trafalgar, we're always looking to see our chairman's pack, are they the most user-friendly and effective means of reporting that will allow both us and yourselves to easily identify and assess what the financial situation is. We see ourselves as partners to you trustees to try help sort out the financial position and allow for the body corporate and the HOA and all your complexes, all your buildings to actually easily manage and to have the best practice of financial management. So what we have actually done is we've re-looked at our financial summary dashboards at the beginning of the chairman's pack, and we've come up with a new format. This is now going to be implemented in the next month. So the August chairman's packs and monthly reports that you're going to get in September, and they cover different sections. So I'm going to go through what it's going to look like. So the first section of the summary is actually looking at a financial overview. Now we've looked at and we've discussed previously in the slideshow what are the big pillars of financial management. Cash is very important. We know admin and performance, admin fund and income statement performance is important. Debt is extremely important, your collections. And then we've also identified what are our obligations. So we've taken our first section of just showing you these main areas. And as you can see, we've put cash balances first as comparing to the prior month. And we've actually made it a bit bigger because of the importance of the cash balance. What we'll also show you, if there's a budget that isn't approved, it's going to come up on this first section, financial overview slide. It's going to tell you that we actually need a bit of action. We need to approve the budget. And there's going to be a note. So at first glance, you can see what the big areas are. And comparatives to prior month is always very, very helpful. The next section, so that's the overview of where we're at with those big areas. Then we'll go into a bit more detail. So section 2 is actually going to tell us a bit more about our cash in hand. Cash is very important. And we have a breakdown month to month. So as a snapshot view, although you might get a chairman's pack that has a lot of different sections, it's very thorough, it's comprehensive. This allows you to gauge at a snapshot dashboard point of view what's actually happening, how much money do we have in the bank. Because, I mean, ultimately, I know from myself, I looked at how I budget personally, cash in bank is very important, obviously. Section 3 then talks about our performance. So how have we done for the month compared to on the income statement, on the day-to-day performance point of view. So we're reviewing against budget. We've got a month. You'll see there's a surplus and shortfall for the month, and then there's for year to date. And on top of that, we've also still kept in where are our big variances to budget. So this is a nice snapshot point of view. And we've got criteria, only those variances, unfavorable variances, that are greater than 25% of budget and 5,000 Rand. So we've looked at two ranges there. We're actually putting in this view for you to see, okay, where are our problems? After the admin fund, there's the reserve fund. And important to know and understand, I mean, it has been alluded to that for the reserve fund, it's a requirement. We have to have a separate identifiable reserve fund, and what we do in terms of our accounting and our general ledger accounts is they have their own specific GL account numbers, which don't get mixed up or meshed with the admin fund, and then it's got its own bank account. Now, this is just telling us, based on our balance sheet or our accounting number, how does that compare to our bank account? Because ideally they agree, in this situation they agree, but if they don't, I've just kept in at the bottom, you can see in this example, it's telling us why there would be a difference. Usually there'd be a difference because of timing. Funds come into our trust accounts, whether it's admin fund or reserve fund, it comes in an amount, and it might have not been transferred over. That could be a timing of when it actually gets transferred, or a payment might have been made out of the trust account, which hasn't come through out of the reserve bank account. But it's important, this allows us to see, are we in compliance, our reserve fund to our bank account, where are we at with it? Okay. The next section is debtors. Now, arrear debt is very, very important. And I know there has been a lot of, I think in one of the previous webinars to all talk about collection and debtors. And this is important. You can raise R1 million worth of levies. If you're only collecting 10%, then effectively that R1 million is just a number and it's not in reality where we're at. So with this in mind, we're showing a breakdown from this month to last month of the key points of debtors. So you'll see the top part, we talk about gross debtors, so levies and arrears. The top part is our gross, what is the actual amount owing. Then you get those homeowners who pay in advance because we bill on the 25th for the month ahead, so there's going to be an amount in advance, and that's your net levy. It gives you a bit of a position and allows you from this view to see actually how many people have actually paid us in advance as compared to last month. Then you have those bad payers. So now we're breaking up those arrear legal debtors that have been handed over. Of this outstanding amount, what does that constitute? So you can see we've got a number of debtors with the Rand value of those debtors, and what is the percentage of those legal debtors compared to the gross debtors. And then on top of that, the section behind that just details those bad debtors. Just at the bottom, that bottom part, just detailing those debtors and what do they owe. It's important. We can see how we're managing the debtors. Then on top of that, always very nice to have visual representation of collections. The first graph tells us the age analysis, what's the aging of the debtors balance for this month. And the second part is very useful. We found that it's always very helpful and always becomes a question, how much have we collected to build? And we've used this over a bigger scale, 6-month view, which allows from a quick snapshot, graphical viewpoint, and we've also got the numbers to help in it to see where we're at and how we're doing with the debtors. So all the main areas that we've identified and discussed between all of us to see what will be important to look at for the debtors, we've put into these graphs. Then the next section, so section 6, we want to see what is outstanding obligations. Also very important. We want to know how much do we still have to pay. So we've broken down, we first got our recoveries, and this is more related, a lot of sectional title body corporates. Recoveries is a very key area. Utility recovery, how are we recovering our electricity as compared to the expenditure? What is the percentages of it? And then what is our obligation? That's when the outstanding creditors are. So I was giving you a feel, if you got suddenly a municipal bill of $250,000, for instance, or $500,000, it's going to come up and it shows a bit of a different picture. And then the final section that we looked at is our conclusion. And I spoke a bit about in the budgeting process, and it's been alluded to a few times. Ultimately, what is our net equity position? Are we solvent? Are we insolvent? And this is why we call it the conclusion. So everything together for the month, at the end of the day, we're looking at admin fund, our reserve fund, the balance sheet equity balances, total if it's positive, okay, we're solvent, and there's a nice comment. So we've derived this and put this together as we thought it might be a useful graphical summary, financial summary of where we're at with the building for the month, or the HOA for the month, and even year to date, which can give us allow for more easily identifiable issues to be identified, and to help with better financial management.
All right, thanks very much, Dave. So I think that concludes the formal part of the presentation. I've been answering questions in writing as we go, so we don't have any questions right now, but maybe just a few comments which may help. And based on my experience, it's really useful if a trustee or a director is nominated to cover the finance portfolio. In 2 months' time, we're going to come onto a webinar to discuss the roles and responsibilities of trustees and directors. And one of the suggestions is that portfolios are allocated to individuals, for example, chairman, finance, maintenance, security, etc. But it's really helpful if somebody takes on the finance portfolio and they really take charge of approving the budget, championing the approval of the budget, as I mentioned. And then really important is to take some time to review the management reports, which are circulated on a monthly basis, typically in the middle of the month for the prior month. Dave just quickly reviewed an updated format, but all the components are in the current presentation of the management reports. And it's really important to go through it. It doesn't take more than half an hour when one's familiar. We've got training, YouTube clips on going through the information and the format. But really important to have a look for what is being reported. Are there any concerns or risks or gaps or variants which need to be managed and need to be resolved? Because ultimately that's the dashboard, the financial dashboard, which is giving the necessary reporting and decision making to make sure that the financial management of the complex is on track. And if one remembers that the budget and the levy income is set to cover the expenses, if the income statement is showing expense variances, meaning that the expenses are exceeding budget, that is a red flag, because all of a sudden it means that the levy income set to cover those expenses is not going to be enough. And it would be incumbent on the finance trustee and thereafter the trustees or directors to take a good hard look at those variances and to make plans to mitigate those, to make sure that the variances are correct, number one, and secondly, that they are minimized and resolved as quickly as possible to make sure that the levy income is not going to be stressed and cause risk to paying creditors for the building. So, it's really important to spend the time, check the reports, to refer queries directly and quickly to the portfolio manager to be resolved, to make sure that each and every trustee or director meeting has a finance topic, that time is allocated to review the reports, that preparation goes into the meeting so everyone has read the report, comes ready with questions. That saves time, considering these meetings are typically after hours. And it's just good practice in terms of taking care of the finance portfolio and the important requirements of financial management. And it doesn't need to be complicated, because at the end of the day, one wants to make sure that the budgeted income is coming in. That speaks to the levy arrears and making sure that the arrears are being actively collected and that debt collection is up to date. It speaks to making sure that the expenses are on budget, or if there are variances, that they are understood, correct, and are being actively managed. And it means that the bank balances need to be checked so that the trustees know what money is available, and that certainly any commitments for costs are within the context of the budget and the bank balance is available. So, that's just a quick practical summary of what you've heard so far. We've got some questions now, which I can then refer to the panel. let's have a look here. If what would you say, Dave, if there is no trustee available to serve as a finance trustee, can this role be outsourced?
So I think if there is, for every building that we manage, there is a dedicated accountant and a portfolio manager. So I think if there's no direct trustee or finance trustee, the accountant themselves can still engage with the trustees and take that maybe extra expertise in the finance section and discuss and meet with the trustees as a whole.
Okay, no, good. And I'll just mention the executive managing agent role. So that was a new provision in October 2016. So more and more we're finding that owners or residents do not have the time or the energy or the inclination to serve as a trustee at all. So it's becoming harder and harder to find volunteers and people willing to be nominated to serve as trustees or directors. In the case of sectional title, the whole board of trustee function can be outsourced to an executive managing agent, and that would be an experienced individual that would cover the roles and responsibilities of the trustees in totality. And in that way, you know, certainly the finance function with the others can be outsourced. Karine, can you quickly answer this one? What is CSOS for, and how does it benefit the body corporate once registered?
CSOS stands for the Community Schemes Ombud Service, and it is basically a legislative requirement that all community schemes must be registered with CSOS and pay a CSOS levy. The CSOS levies are used for the biggest function of the CSOS, and that is dispute resolution. So it makes the dispute resolution very not expensive, and I don't want to say cheap because that's not a positive word, but basically for reconciliation you only pay 50 Rand, and for adjudication you only pay 100 Rand. If you compare that to legal, taking the legal route and taking legal action, which can go into thousands of Rands, so that's definitely a more affordable way to do it. So the biggest function of CSOS is dispute resolution. They also have a function of approving levy rules for bodies corporate, and there's no extra charge for that. And then they also can assist through their conciliation or adjudication. They can also assist with collection of levies. So I hope that answers the question.
Okay, thanks very much. I think so. Shaheen, can I ask you this one? Who's responsible for allocating an expense either between the admin fund and income statement or to the reserve fund income statement?
So basically that would obviously be the trustees. I think the Act does provide that if for whatever reason you're running out of money in your admin fund, the trustees can actually use that, because I mean it's pointless saving money if you can't cover the day-to-day and keep the lights on. So I don't believe that you can actually say that you can't touch the money. So I think the trustees can make that decision to actually make sure that the levy base for the admin fund is adequate to cover day-to-day expenses, because the last thing you want is for the water lines to be cut off, but you're trying to save for the 10-year plan.
Okay, thanks, Shaheen. That's one of the practical pitfalls that we do see, and why it's really important to check the management accounts and income statements carefully, and that's got to do with the allocation of expenses. So practically it's important to allocate expenses to the correct GL where that expense was budgeted, meaning that the expense is going to be matched correctly to the budget item, and therefore any variances are meaningful and can be interpreted correctly and actioned correctly. If one's allocating expenses to incorrect general ledger codes and incorrect budget items, it does make the variances that much more difficult to interpret and escalate an action. And the same principle applies to the reserve fund. So definitely, because reserve fund levies are being raised, because a reserve fund income statement is being maintained, it's really important that reserve fund costs, which relate to preventative maintenance and the 10-year maintenance plan, are correctly allocated to that income statement itself, so that those variances and that income statement report can be accurate. So hopefully that does cover that question correctly. Shaheen, I've got a very important question here with municipal accounts and what can be called bill shock, but a significant municipal cost based on a correction. And, you know, how does that get handled in terms of the accounts, and what should the trustees or directors do in that case where a huge cost comes out of nowhere and it hasn't been provided for in the budget or the cash flow?
So I would suggest that obviously the account is accurate, that the trustees are allowed to actually call an urgent special general meeting, or they could potentially just raise a special levy. And obviously they are allowed to raise a special levy in terms of the Act, and just ensure that the owners are quite aware of what is happening. The issue there around the municipal accounts, which I've alluded to earlier, is that obviously now on a monthly basis, we need to make sure a couple of things are going to be happening. That for all municipal accounts, you have to have a rates account, an effluent account if it's on the common area, a water account, and also to actually have a look at the tariffs. And we're not expecting people to actually be specialists in these things, but for every community scheme, there should actually be a set of municipal accounts. And if someone knows that they haven't paid water by every many years, we should have adequate provisions for those accounts and ring fence those monies so that things like this doesn't happen, Andrew.
Thank you, Shane. Corinne, one for you. What do you do if CSOS has not resolved a dispute? Where can one escalate to from there?
Okay, so basically with the two processes at CSOS, it has to be resolved. It has to come to an end. The first process is conciliation, where they just facilitate the two parties to come together and speak to each other to try to get to resolve the situation. If that is not happening, if the two parties cannot resolve the issue, then it must be referred to adjudication, which is also at CSOS. And with adjudication, it's basically like a court case, if you want to compare it with that. So you have an adjudicator who is like the judge, who listens to both sides, listens to the facts, and then gives an award. And so basically they give an order to say, you are right and you are wrong, and this is what needs to happen. And that order of the adjudicator can be made an order of the High Court or the magistrate court, depending on the jurisdiction of the court. So I don't really see how a resolution or a dispute that has been taken to CSOS cannot be resolved.
Thank you. Dave, one for you. I've got a question here. Is it wise to outsource cleaning instead of having your own employees? And maybe you could just refer to outsourcing in general as a principle.
Okay. So there are pros and cons, obviously, to outsourcing as well as to having your own employees. Now, it all depends, in what I've seen, depends firstly on the entity, the state, the size of the state, and how many employees do you actually have as a whole. Because it has been more common now to do outsourcing. Where your pros come in from outsourcing is you don't have the risk of the employees, of the PAYEs, of the workman's compensation, and if for some reason it's not going right, it's easier in a sense to move SLAs, change service providers, than all the disciplinary and all of those actions with the employees. So if it is I've seen with bigger states that they do have their own staffing, and obviously it's good to be an employee for the country, and you can get ETR benefits, but outsourcing has become a lot more of a common trend, just in the whole fact that for the industry, you've got a body corporate and HR, you've got directors moving the whole time. It tends to be a lot easier to manage and control with an outsourced company than it can be with your employees. So again, I've seen a lot of cases where most of the time the cleaning services are actually outsourced, and it's more based because it's easier for the directors and trustees to actually manage the KPIs and responsibilities based on one person at a service provider than the individual employee.
Okay, so I mean, it does come down to the management time and capacity to manage employees in-house, as it were, for employees employed directly by the building. And if there is no capacity or time from any one of the trustees or a caretaker to manage those staff, then outsourcing does become an option, a good option, and it should be budgeted accordingly. All right, in a deceased estate, Corinne, can trustees demand a payment from the executor of the state before it is settled? And this is a common problem we see where arrears collect in deceased estates and also in properties being sold.
Andrew, yeah, I don't really know the answer to that question. as far as I know, with a deceased estate, you have to wait until the estate has been it has been resolved. The file has been closed. I think it will be best if maybe that person who asked that question just email us, that we can refer it to one of our attorneys.
Yeah, look, I mean, I can say that it is a common problem. We often see that in a deceased estate, levies are not paid, the arrears collect, and it can create pressure on cash flow in a building. Typically, we would try and trace the executor, because the executor would be responsible then for funds available, for paying creditors and winding up the estate. And it would be correct for that executor to pay levies and to service debt in the estate. But, you know, typically the executor has a lot of other admin and doesn't often prioritize the payment of levies. Very often these properties are sold, and the arrear levies are then collected through the clearance process of the transfer, and that's handled by the conveyancing attorney. So the same principle applies with properties that are sold. You know, typically the owners stop paying their levies because they are, you know, waiting for the property transfer to go through. But once again, the clearance and transfer process do catch up the arrear levies, because the property should not be transferred until the arrear levies are up to date and the complex's interests are reserved in that process. So I think that would be an answer, but it is a challenge, and a discussion with the executor is highly recommended. Shahim, the adjudicator has ruled in favor of the complainant, and we're waiting for documentation to make a CSOS ruling in order of court. But they're struggling to get the document from CSOS. What would your recommendation be to try and resolve that predicament?
I think we've got quite good contacts with CSOS, so I think they can email Karine and we can deal with it. But I know that CSOS at the moment is backlogged, but what people must also remember is that even though it can be an order of the court, if someone defends that, then they can also go to their own attorneys to deal with a matter like that, Andrew.
Okay, thanks. So if you email Karine Kutsia, which is karinec@trafalgar.coza, with the reference number of the dispute, Karine will be able to follow up with some of the senior contacts that we have there. Dave, do audited financials have to be sent to CSOS for homeowners associations?
They do get submitted with the annual return. And for homeowners associations, you would also submit them with SIPSI, because if they're followed by the Companies Act.
Yeah. Okay, thank you. A good indication of financial management which is on track, which is up to date and certainly is effective, is that a complex, a community scheme, would have its annual general meeting on time. It would be able to sign off at its audited financials fairly easily and quickly. There would be a surplus that's accumulated in the necessary funds. There would be cash flow to service creditors. There would be no risk in terms of municipal disruption, and certainly that maintenance is up to date. So those are good indicators that the financial management is well managed, that the trustees or directors are on top of those responsibilities, and that the budget forecasting is effective. So I think look for those indicators. And, you know, why is this all important? This is really important because, you know, when somebody sells a property, typically the estate agent will ask us for a copy of the audited financial statements for the most recent AGM minutes, and those documents are reviewed by buyers that are looking to buy in complexes. The banks also ask for financials on an annual basis, and their lending practices are very much influenced by what they are finding in the financials. So if a complex is financially challenged, if it's insolvent, you will find that banks will not be lending, will not be granting bonds in the complex, and that will have a significant impact on the property valuations and therefore the asset value in these properties. So there are very real and very practical implications in terms of getting this right and making sure that the correct priorities are met. You know, we do recognize that financial management and interpreting these reports is not comfortable to many people, especially those that have not been exposed to financial reporting and financial management and terminology. So please do reach out for help to your Trafalgar portfolio manager, to the Trafalgar accountant working on your complex. They're more than happy to spend time with you to work through the financial reports, to answer questions, to provide guidance and to provide support. And if you're finding you're not getting the answers you are hoping for, looking for, you can see Shahim Carr and David Hershowitz on the screen. They are senior stakeholders in financial management, and they are very willing and able to help. This is their core expertise. They enjoy this. They enjoy turning buildings around. They enjoy coming up with plans to improve financial management, reserves, and cash flow. And that help is offered to all Trafalgar clients. In fact, we provide advice to external buildings as well. On the screen, you can see Corinne's email address, so please reach out to Corinne for any questions. My email address is andrews@trafalgar.posa, and you can email me for the presentation or the YouTube clip. We'll be glad to do that. Just a heads up for the topic for September. The next webinar will actually be on Wednesday, the 23rd of September, because the Thursday is a public holiday, so it's going to be at 4 o'clock on the 23rd. We will send out the standard invitation. The topic of discussion is going to be the insurance of community schemes, looking at both sectional title insurance as well as insurance for homeowners associations. It's a really important topic because it obviously mitigates risk. It's a legal requirement, and certainly in sectional title, there's specific types of cover which are provided for. There's quite a lot of fine print which we'd like to go through, and we're going to have the manager of our insurance division, Blighty Pinto, will be part of our panel with myself, and we'll be going into some detail and talking about the claims administration process. So many thanks for joining us today. I hope you found that informative. Once again, any questions we did not get today, we'll be pleased to answer by email, and then we look forward to welcoming you at the next webinar on the 23rd of September on the insurance topic. Thanks very much indeed, and good afternoon to you all. Bye now.